Reserve balances at the Fed this past week fell again to 2.93 trillion, and a sign that liquidity in the market continues to tighten. And that's going to be a especially important topic this week, given that we have large settlement dates coming up. In fact, when we look, the 28th, we're going to have 26 billion in Treasury settlements. On the 30th, we're going to have 25 billion in Treasury settlements. And then on the 31st, the last day of the month, we're going to have 58 billion in Treasury settlements. And so in total, we're looking at about $109 billion settling this week. And that's going to have a significant impact on overnight funding rates. And when we look at things like SOFR, which has been one of the key measures in terms of overnight funding rates, you can see that rate right now is at 4.25% practically. And that's really the upper bound of that band that the Fed has between 4% and 4.25%. Now remember, the Fed's likely to cut rates this week as well, and so we're going to see this number move lower to adjust for the lower Fed funds rate. But it's important to remember that, right now at 4.25%, basically, it implies that we're basically at the lower bound of where the rate was prior to the Fed cutting. And this is a sign that liquidity in the overnight funding market is fairly tight. That it's not only that liquidity is tightening in the overnight funding market, but that you're seeing the volatility in the overnight funding market really expand. And this is SOFR minus the interest on reserve balances. This is SOFR minus the effective funds rate. And this is SOFR minus the reverse repo rate. And you can see in all the cases how the volatility has increased and how the spreads have widened pretty dramatically. And this, again, of course, is a sign that liquidity in the marketplace is thinning out. Also, what we've noticed, too, is that the effective funds rate has been gradually trending higher as well. Again, signs that liquidity has begun to thin out. And what we're seeing is that, at least based off of trading on Friday, in the DTC, the average rate on the repo market, it's likely that we're going to see SOFR rise again on Monday morning when we get the data for Friday's trading session. And what's important, again, is that when we have these net settlement dates next week, it's probably going to mean that we're going to see increased usage of the standing repo facility. But before we get too far into the video, I just wanted to remind everyone to please remember to subscribe to this channel, like this video, share with your friends, and I need your support to help me continue to grow. What I've noticed more recently is that on days of big Treasury settlements, you tend to see usage of the standing repo facility increase. You can certainly see at the end of September it was used, but that was also quarter end. But then if you notice, more recently we've seen this really begin to pick up, particularly on the 15th. And the 16th of October, then again on the 21st and on the 23rd. Notice on dates when there's no settlements, we're not seeing any activity in the standing repo facility. That would mean we probably will see activity on the 28th, the 30th, and the 31st of this week for activity in the standing repo facility. And it's very possible that we also see those funding rates probably move higher as well. And this comes at an important time because obviously the Fed is having its meeting this week, and there's some talk that maybe the Fed will opt to, stop quantitative tightening. When we look at the activity, though, it's not like an overly concerning amount of activity. When you go back and you look at this thing historically, you can see the standing repo facility was used historically on quite a regular basis, and certainly even if you go back to the 2000s, it was used even more, and the daily values when there were certainly less money on the Fed balance sheet was quite larger than what we're seeing right now. So it's hard to say that the Fed is in dire need of having to stop QT. It looks to me more like the balance sheet is just finally normalizing, and the excess liquidity that was in the market is finally getting drained out, which is probably really needed given how elevated asset prices are today. I mean, the reverse repo facility on Friday just reached $2.4 billion after hitting a peak of almost $2.6 trillion back in December of 2022. So all of this liquidity has essentially needed to drain out of the marketplace. So what's happened is that over the years, as the TGA as the reverse repo facility has been drained, we've seen, basically reserve balances not really change by very much or not see the big effects of quantitative tightening, because as the reverse repo facility was draining, we saw essentially the offset of quantitative tightening. So as the Fed's balance sheet was draining, the reverse repo facility was adding reserves back into the system. And so you had this net kind of sideways and choppy period of time in reserve balances. And now that the reverse repo facility is drained, you're now officially starting to really see those effects of quantitative tightening beginning to really hit. The important thing here is that, when we typically see, and one would think that as liquidity continues to tighten, that there would be a risk to risk assets as well, and that you would see potentially an impact there, but through lower asset prices. And so, this has been ongoing now since July, and it's likely to continue to be the case as long as the Fed continues to do quantitative tightening. Now, part of the thing is that the TGA has obviously refilled right now, and it's running above its target of $850 billion. In fact, this doesn't have Friday's number in it, but I thought I saw it was near $950 billion. So what that probably means is that the reserve balance number is understated by about $100 billion, because at some point this $950 billion is going to be shrunk back down to about $850 billion, which means that reserve balances will be offset and rise by $100 billion, closer to probably back towards that $3 trillion mark. So, I mean, if the Fed were to allow quantitative tightening to continue for a little bit longer, that would probably mean that you're going to see, in the end, sort of the balance sheet end up somewhere in the $2.8 to $2.9 trillion range. Now, while we can't really say that we've seen stock prices all go lower, we've certainly seen assets like Bitcoin move lower. We've seen a lot more volatility in that space, and certainly, it peaked back here in mid-August. I mean, if you notice here, Bitcoin peaked on August 12th, or August 13th rather, and that was on the same day that you saw the reverse repo facility hit $30 billion. And then we obviously continued to trade down to $2 billion. But if you notice here, what's interesting is that when the reverse repo facility rose into the end of the third quarter, you saw the price of Bitcoin come down, and then as the reverse repo facility drained back down towards this under $10 billion range, you saw another little bit of a boost in Bitcoin prices. So it seems like there is an inverse relationship between things like Bitcoin and the reverse repo facility that are still kind of playing out, and this likely is also playing out and probably seen in Bitcoin prices really suffer. In fact, the one period of time where we got a little bit of a rise in Bitcoin, which kind of took place at the end of September into the beginning of October, happened to coincide with a slight uptick in reserve balances. And of course, as reserves came down, Bitcoin continued to come down. So I think that there is a relationship between changes in reserves and changes in prices, liquidity type assets like Bitcoin over time. And we know that historically there's also been a very strong relationship between the NASDAQ 100 and Bitcoin. And so what's kind of odd, I guess, at this point is that we started to see signs of the NASDAQ coming down last week, but at least as of the end of this week, we saw the market rebound some. So again, there are clearly signs that liquidity is having an impact on parts of the marketplace. Certainly in more of these really liquidity dependent type names like Bitcoin, but we haven't seen all the impacts yet across other parts of the market, such as the NASDAQ 100, which historically has had a pretty strong tie to other liquidity gauges, but you can clearly see that we started to come down, like I said, and now really since, call it, the middle of October, we've diverged again. So we've seen this happen before. That's why I think it's really important to watch these liquidity gauges over the course of the week, because I think stocks are ultimately tied to the direction of liquidity. And if we were to see Bitcoin prices continue to decline, I think it just further strengthens the case that liquidity is being drained from the marketplace, and that there will be an impact on other risk assets. I mean, we have certainly also seen things like, the KRE come down pretty hard more recently, and that's obviously another sort of liquidity indicator. You have seen private equity names get hit pretty hard. Also, another form of liquidity, just not being enough liquidity in the market that's present to kind of keep everything moving. And here's your housing sector index, also not really performing particularly well more recently. So again, I would continue to keep an eye on this. Here's Meta, even, which hasn't really performed particularly well, and that will be a stock that's obviously reporting results later this week. So I think ultimately you have to be aware of what's happening with this liquidity and what the Fed says specifically on Wednesday about quantitative tightening. I personally don't think the Fed is going to end quantitative tightening this week. I know there are some people that think they will, but again, there's nothing really happening in the overnight funding market that suggests there's chaos. It's certainly tighter than what it was, and liquidity is being drained from the marketplace. But I think that's actually a good thing, because you'll actually have markets begin to trade in a more normal and predictable way, as opposed to a market that's trading solely on the ebbs and flows of liquidity. And so that's really all I'm going to have for you this week. Please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again soon.